The stock market should have already crashed. Every single indicator is flashing red. Consumers are drowning in debt. The economy is showing cracks that are impossible to ignore. And yet, the market keeps rising, defying logic, defying history, and confounding experts. Why is this happening? Why is the financial system holding together when every historical warning sign screams catastrophe? I am the financial coin historian, and I have spent years working in the heart of finance. I look at markets not with the blind optimism of a trader or the greed of an investor, but with the lens of a historian, one who understands that history may not repeat, but it certainly rhymes. What we are witnessing today is a paradox, unprecedented in both scale and consequence. We are at valuation levels far higher than the peak of the dot-com bubble, yet the crash that everyone expects is being delayed. And the truth behind this delay is something Wall Street does not want you to fully understand, because once you see the forces at play, once you understand the hidden mechanisms quietly propping up this market, you realize that this delay is far more dangerous than any crash itself. This is not a prediction of doom. This is an exercise in pattern recognition. Let's break down the sheer scale of valuation insanity, expose the hidden forces that are keeping the market afloat, and uncover the mechanisms of risk externalization that allow Wall Street to shield itself from the reality most investors ignore. At the foundation of this paradox is a simple fact. Every fundamental indicator screams that the market should be in free fall. Let's start with the metric favored by Warren Buffett himself. One that compares the total market capitalization of all public companies to the U.S. gross domestic product. DARE. Historically, anything over 100% indicates a market detached from reality. Right now, the total market capitalization of all U.S. stocks is roughly $66 trillion. The U.S. GDP stands at around $30 trillion. Divide the two, and you get 220%. To put this in perspective, before the dot-com crash in 1999, this ratio peaked at 115%. When it did, the market subsequently collapsed by over 60%. Today, we are standing at 220%, a level that is historically unprecedented, and a concentration of risk that is almost unimaginable. The delusion is not only in the soaring price-to-earnings ratios, but also in the extreme concentration of growth in a few select names. Historically, the S&P 500's PE ratio hovers around 15 to 16 today. It is running 25 to 28, already dangerously high. But the real problem lies in the concentration. Companies like Nvidia and Tesla dominate the narrative with PE ratios of 53 to 55 and 286, respectively. Investors are paying $30, $40, even $50 for each dollar in earnings. This is the classic madness of men, a phenomenon Isaac Newton described after losing his fortune in the South Sea bubble. It is the echo of 1999, echo of irrational exuberance that history has repeatedly shown us leads to catastrophic outcomes. Despite all these warnings, the market refuses to collapse. And the reason it refuses is the presence of potent, self-reinforcing forces that Wall Street relies upon, yet prefers that you do not scrutinize. The first of these forces is government spending coupled with currency debasement. Governments issue massive amounts of debt, which the Federal Reserve accommodates through digital money creation, otherwise known as quantitative easing. This flow of money does not touch society evenly. It flows first to the financial system, to banks, to governments, and to asset owners. This phenomenon is known as the Cantillon effect, a 300-year-old principle that dictates who wins and who loses during monetary expansion. Essentially, wealth is transferred upwards from the many to the few. The top 10% of households, who own nearly 90% of all stocks, benefit the most. As the dollar devalues, asset prices inflate, making the wealthy even richer. Inflation, far from being a flaw, is a feature of this system. It punishes cash holders while rewarding those who buy assets with borrowed money. The market is being propped up by a narrow set of drivers and mechanical processes that amplify momentum, creating the illusion of stability. The second force is the AI engine. Corporate profitability today is overwhelmingly driven by investments in artificial intelligence. The absolute valuation of AI giants is unprecedented, creating extreme duration risk because these valuations assume highly extended growth in earnings. When growth expectations fail to materialize, these stocks could experience dramatic downward corrections. The third force is the dominance of passive investment strategies. Today, passive funds account for over 50% ownership of the S&P 500. This dominance disrupts price discovery and mechanically amplifies both upward and downward movements. When a downturn occurs, passive funds must sell proportionally to their index holdings. This means that concentrated large-cap stocks will face amplified selling pressure, causing crashes to occur faster and harder than ever before. On top of this, post-2008 regulatory reforms like the Dodd-Frank Act were designed to make regulated banks appear resilient while allowing them to shift their riskiest exposures to the opaque, less regulated non-bank financial intermediation sector, also known as shadow banking. This $4 trillion system is not subject to the same capital rules as commercial banks, hiding critical systemic risks such as elevated default expectations in leveraged lending markets. The conventional banking system appears stable, but the vulnerabilities are lurking just out of sight, ready to trigger systemic contagion when the slightest spark occurs. The market has not crashed because people mistake delay for safety. Every generation believes it is smarter than the last, right up until the moment they lose everything in the same way their predecessors did. Bubbles are never accidents. They're engineered, often deliberately, by those with money and power. The South Sea bubble, the 1929 crash, the dot-com collapse, the 2008 housing crisis, all built on the delusion that this time is different, and it never is. Crashes unfold in three distinct phases. The first phase is irrational staying power, where markets remain high for longer than anyone thinks rational. We are in this phase today, with market valuations entirely disconnected from reality. Phase 2 is crash fatigue, where investors become numb to bad news. Layoffs, inflation, earnings warnings. Nothing moves the market anymore, and this is classic pre-crash behavior. Bad news stops mattering right before the moment it matters most. The third phase is the confidence break. A single event, a bankruptcy, a credit event, or a major earnings miss triggers a cascading collapse. The longer the crash is delayed, the bigger it becomes. The truth is structural. The system's stability rests not on gold, productivity, or fundamentals, but on confidence. Confidence is the easiest thing to lose and the hardest to rebuild. When the system eventually breaks, the rescue efforts rarely benefit the average citizen. The laws are written to protect institutions, not savers. Too big to fail means the wealthy are protected, while ordinary people bear the brunt. The outcome is always a transfer of wealth upward. Meanwhile, holding cash is effectively a guaranteed loss due to perpetual inflation. Functioning as an invisible, lifelong tax designed to erode debt and push citizens toward speculation, financial sovereignty begins with intellectual sovereignty. The wealthy protect themselves by positioning outside the reach of fragile systems, owning income-producing assets like land, businesses, or intellectual property. They hold real value that cannot be inflated away or frozen by decree, such as gold or scarce commodities. In conclusion, the market has not crashed yet because the hidden forces of leverage, concentration, and regulatory arbitrage hold the illusion together. But physics does not bend for finance. You cannot expand claims infinitely without real backing. When collapse comes, it will be sudden, brutal, and wide-o, and only those who understood the structural weakness beforehand will be ready to seize the massive opportunities created by forced liquidation. History, as always, provides the answers, but only for those willing to see the patterns, understand the forces, and act with clarity while others are still blinded by illusion. The market waits for no one, and the truth never hides forever. The time to prepare is now.